What's up, everybody, and welcome back to the Junior Markets YouTube channel. If you're tuning in from YouTube, make sure to check out my website at Junior Markets. I go over everything in this video in a lot more detail, as well as a lot of other things. And if you're tuning in from the website, this should be on the Evaluate a Company page. And the goal of this video is to just evaluate the company on the website. Today, that would be Docebo. And we're just going to be going over how I evaluate a company and how my professors in college taught me how to evaluate a company and some of the things that I think are most important to look at. So the company today, like I said earlier, is going to be Docebo. And now I'm back on Charles Schwab's website. As always, I think this is a great website. And if you're looking for a brokerage account, make sure to give the Schwab a try. And so as you can see, it's up today, but the main things you want to look at when evaluating a company. Now, you might have gotten this info about the company from Yahoo Finance or a podcast, or you saw a news tip on CNN or whatever, and you saw this company and you saw someone saying that they think it will go up in the future. And then you say, well, I want to get in on this. If that guy thinks it's going up, I want to be a part of this too. So before you just jump in and invest, you need to do a little bit of research on the company beforehand. And so that's what we're going to go over today. So now the first thing, before you invest in individual stocks at all, you need to understand the company. Now, this isn't coming from me. This is coming from Warren Buffett, one of the greatest investors ever. He says if you don't understand the balance sheet, the income statement, and what the company does and how it makes money, you don't need to be investing in individual stocks. So first off, you need to know what the business does. And on the Schwab's website, it gives you a full business summary. I'm not going to read all of this, but as a quick go over of what this company is, it's a learning management system. Now, I had a class in college where we talked about learning management systems, and I thought it was a really cool concept. It's been around for a while, and Docebo was the first company to put artificial intelligence into this learning management platform. And so I thought that was really smart, and I wanted to get a piece of this new technology. So overall, the first thing you need to know is understanding the business, what they do, and how they make money. And so we're going to be going over how they make money next. So understanding how a business makes money is very important. And going through some of this, it tells you how Docebo makes money. Essentially what they do is companies contract them and then they integrate their software into the company. And then Docebo's software will do whatever this company needs in terms of learning management. So it'll teach them all of the software, and then it'll teach them what they have to do for the job, all that type of stuff. And then these companies that use Docebo will pay a monthly subscription to Docebo to have their software and learning management system and all of the options that it provides. So the first step, as I said, is understanding the business and what it does. Now the next step is understanding how they make money, which I went over. And now something that I like to look at, especially for a technology company like this, is customers. Who are they supplying their product to? And Docebo makes it really easy. They have a customer list on their website. And as we can see, Amazon, Zoom, Capital One, these are all very well-known names, and I found this very attractive. So now that we went over customers, something that I like to think about is, where do you think this company's competitive advantage lies? Why do you think this stock is underpriced? And what are your assumptions for the future? You want to have a target price that you tell yourself, I will sell at this, so that you don't get fear of missing out in case the stock goes higher and it ends up going lower and you miss out on your opportunity. So I looked at this company's advantage, and of course it was the artificial intelligence, the AI, which I really liked because AI is the future, whether you like it or not. So the main thing you need to figure out is, where is your company's competitive advantage, and what are they doing that is more impactful or better than their competitors. Now, a few more key things before we get into some metrics down here is, I like to look at mergers and acquisitions, is your company buying and taking over other companies to help them expand and take on new technology? I also like to look at management. So one thing that my professors have taught me is take a quick look at the CEO, the board of directors, things like that. See what their experience is, what their plans are for the future, how they expect to grow the company, things like that. And that's very important just to get a little bit of insight into management. And now for a company like Docebo, which is a online company, I looked at what their software could be integrated into. So I looked more into their software and some things like that. And their software could be integrated into one in Google Drive and Microsoft systems, while other companies weren't as easily integrated. So this is one of the things that set them apart and gave them a competitive advantage. Now we're going to hop into some metrics and KPIs, and we're going to hop over to Yahoo Finance for that. So now we're over on Yahoo Finance, and I'm using Yahoo Finance instead of Schwab because Yahoo Finance is free. You can use this, just Google Yahoo Finance and then whatever your company is. So on my website, I show this picture right here, and this always just shows some of the basic metrics for every company, such as price to earnings ratio, earnings per share. As you can see, the PE is pretty high, but it's a growth company. The beta, of course, is above 1, so that means it's a little bit more on the volatile range, but that's okay. It's a growth stock. All these are expected. So now something that you can do is you can hop on over to financials, and then this will show you all of the things that you need to look at. Now, some of these you don't have to look at. I know this page looks very overwhelming, but there are a lot of things that you don't really need to look at for technology companies. A lot of metrics are sector specific, so we're just going to go over some of those now. So in the financials, of course, what you want to look for is growth where you want to see it, and decline in some of the places you want to see it. So things such as total revenue right here, you want to see growth over time, and as you can see, we have seen that growth. Now, some other things such as operating expenses. Operating expenses growing are not necessarily a bad thing. That can be a good thing. That means your company is expanding. As long as they have the cash and the revenue to pay off these expenses, that's totally fine. So now we can move down into earnings before interest and taxes, and earnings before interest, taxes, depreciation, and amortization. These two right here. And we can see that earnings, they were negative a couple years ago, but they have gone into the positive, and they decreased during COVID, but that's okay. They're back on the rise. So that's something that I like. And now we're going to hop over into statistics. This is a lot of the metrics that people are used to seeing, such as PE, Ford PE. Now, as you can see, the PE is really high, but the Ford PE is a lot lower, which means that the forecasted earnings are a lot better than the earnings they have now. And we'll move into some other ones. So moving into some of these, if we're looking at price to sales first, I go over what all of these mean in my metrics video, which I believe is the video before this. It's also on my website in the metrics under the investing tab. But as a quick refresher, the price to sales compares how much an investor is willing to pay for a stock compared to the company's revenue. And this is trailing 12 months, and you normally want this to be below 1, which means a strong share price performance. As we can see, this is kind of high, but it is going down, so that's totally fine. And with growth companies, you can expect a higher number. Same thing with price to book. This compares a stock's current price to the net worth of the company's assets. So a lower multiple is normally better. So as we can see, it lowered from last year, but it's still up from the previous years. So again, we'd have to compare this to other companies in the same industry, but as long as we're seeing this go down, and it's a growth company, so we just want to see these metrics getting better, not necessarily be at a good place now. We just want to see improvement. Now, I did hop back over onto Schwab's website so I could do some comparisons between Docebo and other companies. The ones they put up are Microsoft, Oracle, Salesforce, and Adobe. So let's go down to some things we haven't looked at yet. So first up, let's do return on assets. And as you can see, the return on assets at 2.89, that's okay. this metric, you want a higher number because that shows more efficiency. But in comparing it to its competitors, it's a little low. But this company is probably spending a lot of money on growth, so we just want to see this improving over time. Same thing with return on equity, comparing it to its competitors. Oracle's kind of an outlier here, but comparing it to its competitors, it's not bad. Return on equity, just as a refresher, it relates net income to the investment made by the owners, so the stockholders' equity, and it gauges the efficiency of generating profits. So you want a higher return on equity, and so we just want to see this again raising over time. And then let's head on down into growth. So I love this 5-year percentage sales growth, 46%. That's a great number. As you can see, it's a lot higher than all the other companies because this is a growth company. We love that growth. And then they don't have a dividend. We'd love to see that in the future. So let's move into some margins. So first we can do gross profit margin, and this measures the income earned on each dollar of sales. So if a company has a profit margin of 80.94 like Docebo, this means for every dollar of sales, 80 cents will go towards net income. So you want to have this at about industry level or above and increasing over time. And as you can see, this is about industry level, so that's something we like to see. And then heading down, I like current ratio for growth companies because it shows its current assets over current liabilities. And this, you want to see it over 1 because current assets are in the numerator. So that means that this company has enough assets to cover all of their liabilities. So now let's head back to the top and move on to our next topic. So moving on into the final thing that I look at, I like to look at KPIs, which are key performance indicators. And one thing you can do is just search up KPIs for whatever your industry is and then companies, and you can scroll down and look at some of the common KPIs. Forbes usually has a good list. So we can go into that. But some things for a tech company, I'm not going to go into all of these, but some things could be customer experience. You want to see customers coming back year over year, especially with subscription base. Mean time to repair, so how quickly a company can repair when their servers are down, how quickly a company can detect when their software is being hacked into, flow efficiency, lifetime value. So I like user lifetime value because this means this is how well you can retain customers, and as always, retaining customers and keeping customer satisfaction high is one of the best ways to grow your business. So now going into some final thoughts here, this is the end of the video. And just to reiterate everything we've gone over, first off, you want to understand the business. What is the business? What does it do? And how does your company make money? You must understand how your company generates revenue. Now, you can find this just by looking it up. You can find it in a 10K on sec.gov. That's free. And thirdly, you want to look at growth. How do you expect your company to grow? What is management doing to grow? Are their metrics improving? Are their revenues increasing? Things such as that. And you really want to compare your company with other similar companies to see how it stacks up. And again, look at those competitive advantages. So that is the end of the video. That is how I go over a business. And now I'm going to show you a Word doc where I wrote down everything and what it kind of looks like. So now I am in Word, and what I like to do is just make a Word doc of all of the most important things for the company, just so I can put it all and see it all in one spot. So as I went over some of their competitive advantages, where their offices are located, customers, partnerships, things such as that. I went over a few of the metrics, and then some of the growth metrics, and then revenue increases. I also went over some of the negatives. So I like to put it all in a Word doc. It makes it a lot easier for me. So we have come to the end of the how to evaluate a company video. I'm running a little short on time, so this might be kind of quick. But as always, check out Junior Markets website as well as @Junior Markets on all of these platforms listed. And have a great day.